we had exciting week till the following week comes, and I am so happy that you could join us, and I hope we will continue this journey together and be even more prepared for the adventures that's ahead of us. I really like this. I've had this reading for many years, and that has been my goal working on myself. Buddha had said, "A man who conquers himself is greater than one who conquers 1,000 men in battle." And I think it applies not only in aspects of our business relationships, but also with the markets and in life. And basically, sometimes we feel that the markets are a challenge. Uh, they are we are at the mercy of the markets, but especially if you are someone who is working on a short-term investing and trading, knowing thyself, knowing who you are, what are your again mindset, and from the psychological point of view, which helps your money management, I think it's more important than actually understanding the technical side of things. And this is really, it hits um, big note with me. The other thing I want to say, this is the way I look at the markets. The markets are neither your friend nor enemy. Instead, you have to look at them as a vehicle. They help you to go where you want to go. But if you're not careful, it could result in some painful accidents and hurt. So the minute that you get into markets and you think, I've heard this many times, as soon as I got in, I, it seems like market is watching me, so it goes against me. And as soon as I get out, it goes up to my way, and it's like, yeah, it's like somebody's watching me. Well, there's not such a thing. You are in control, and one of the biggest purposes I have with our, again, gatherings here on weekly basis that I really enjoy. You're such a wonderful group. It is to give you the tools to be more in control of yourself, having the confidence, knowing your system, knowing your discipline, knowing who you are. So the markets are just a system. The markets are going to do what they need to do. Their job is obviously to take money away from you, because there's always two ways. Most of the markets are symmetric in a sense. So, but your job is to be in control and control your risk, and it's the money management. And as long as you do have that, life becomes much more easier, and it also your journey becomes more enjoyable, because you know who you are, and you know what your purpose is. Every week I like to look at, I really like this from the Department of Labor and the First Trust Advisors. It just gives me a little picture of what is happening in the past week. It's much better than what the government numbers comes as a whole. We look at the CPI retail numbers, but underneath the hood, something like hotel occupancies and what rates they charge. And I look at the TSA. So if the airlines are going up, and well, it's nice, their stock is going up based on, again, projection that the people make themselves. It's not something concrete. This is concrete. I know, wait, this is a good direction we are going. I've taken a few flights in the past couple of weeks, and I can see that, but I see a lot of challenges. So these are the challenges over the year over year. So I like to look at under the hood and see what is the reality. Also, again, this was more of a health challenge rather than the fundamental, although I think we did have some problems even in December, but the catalyst was the health problems. And so obviously we all watch the states. We are watching New York, New Jersey, Connecticut, and then Texas, Houston. And this was interesting that Arizona, just in the past week, they had a rise in their cases. But then we got to look at deeper, a couple of things. I think what they're doing more testing in some health centers and the prisons, which is the odds are, when you're in the congested areas, you will have more cases. In the meantime, the death ratios have gone actually stabilized, but also Arizona has much more older population than some other states. But still, this tells you how uncertain things are. Going back to the week, just looking at the barometer, what happened, as you know, I mentioned last week, we want to watch the FOMC meeting, because after the last Friday's the employment numbers when they came, which caught a lot of people by surprise, we wanted to see what the Fed chairman thinks about it and what the committee thinks about it. And the thing was, the markets actually tell us, and that's why I like some of the technicals to look under the hood again. So we were kind of knew that there's going to be some volatility. And to that extent, as you can see, we had the performance. Dow Jones was down 5.5%, the S&P 4.78, NASDAQ composite was 2.3. These are from the Barron's. And then also, one of the things is all about volatility. And I really like this, we will talk a lot more about the VIX index, which is the volatility index. It kind of called the fear index, rightly or wrongly. It's not 100% true. It's all about the options premiums on the S&P. But anyway, it does give us some parameter of what is happening in the markets. I emphasize, I look a lot into the put-call ratio. I have a chart every morning I review to see, is there complacency? And basically, we will discuss a little more. You can see just last week, this is an index, on S&P, this is all the equity options. And you can see for every 5 million puts, there's 10.5 million calls. So that tells you there's, again, a lot of hope and a lot of, I would say, euphoria. And that's what last week was 43%. Actually, it was lower than that because I watched the 10-day moving average on a put call ratio, and I had not seen it in a long time. So the averages have been, when they get close to 50, that's like a really warning sign. And to talk a little more as far as the numbers, you can see last week we had, when the markets went up on Friday, a lot of economic sensitive, the cyclicals, they were the winners, which tells us a little about the speculation, and the money kind of moved out of more established large cap growths, equities, and technology, and they moved to, let's say, financials and transportation, energy. And because of that, they were the big winners. We talked about the value was more, but this time, as you can see, the small cap, S&P small cap was actually for this week, when the sell-off happened, they were down the most. So the money kind of left, and then you can see the NASDAQ, the big cap stocks, and technology stocks, they were down only 2.3%. Now, the Russell, which represents the 2,000 smaller cap companies, they were down 7.93, and the transportation, we will talk a lot more about that, which includes, again, railroads and the airlines, they were down 8%. So again, we are developing a story, and you will see this story will be for the next hour or so. Are there any consistency of what's happening, or is there any anomaly? Now, last week, we had 400, the week earlier, we had 2,669 advances for every 376 decline, and how the market psychology can change so rapidly that we go from that to, this week was the 416 advances to decline. So again, we want to see, is there any consistency or continuity? The dollar had one of the better days, and they were up over the week before. You see the bond market, which was I showed you the chart last week. We went from 0.67 or 0.65 to 9.96 percentage, which is a huge, huge increase. And there was a sell-off in bonds, and all of a sudden we are back, and we had nice gains, and the money again moves back to the bonds, which is more of a security. And the gold also, you can see the gold was up, the crude oil was a little down, which is again the economy. We'll look at the charts, and basically at the end you will see that things probably coming together. And again, this is a repetition in a sense, but I also like to look at some of we talked about global investment last week, and made a case maybe it is a time you want to explore some of international, especially the way the dollar has been and the way the decade we had in the 2010 to 2019 or 2009, 2010, 2019, in the past 10 years, really the US was the big winner. A lot of, I mentioned from 2007, 2008, the tops, some of economies still haven't hit, their markets haven't hit the high of those years. So there are opportunities out there. You just have to be selective. You have to find the best potentials and the strongest companies. I mean, look at what happened last week. As we were down, we look at the total market was down about 5%. Asian Titans was down only 1.34. The global Titans were down 2.75. And even in Islamic markets, which are smaller, they weren't as losing as much as what we did. And then we look at, like, let's say, India's and we look at also the sector-wise, look at the internet and e-commerce. So, all right, horse manure, New York City, and automobiles. As you know, the FOMC, Chairman Powell came on Wednesday at 11 o'clock, and then he had his Q&A. One of the objections I've had in the past, especially since March, when the Fed interfered immediately, obviously they dropped the rates, but then after that, in April, on that famous Thursday, when they came and they started buying the investment graded and the high yield and junk bond funds, the LQD, J&K through BlackRock, or through Treasuries and the BlackRock, that kind of didn't sit well with me. I mean, I could understand why they were doing that, but basically what they're telling the markets, that we are rewarding the bad behavior. There are some companies out there that have made the bad choices, but it's okay, we're gonna save them. And what I mean by that is, and I could understand, let's say the LQD, which is the investment grade bond fund, what they have, the fear was, if you go from the triple B to double B, there's gonna be a big sell-off because a lot of funds, they have to adjust their holdings, and that's gonna be a domino effect. But the question is, where do we stop? Now, in the turn of century, into the 20th century, in the New York City, the horses were, people were transportation was through horses. The horse industry was a big industry. And the horse manure was about 2.5 million pounds a day that would be cleaned. So the horse, I don't want to say union, but the horse industry had a very strong presence. So they wanted to keep that business going. With the automobiles, obviously they were being threatened. But that was the adaptation time. So the way I look at it is, and I put this, I said, imagine, we didn't have the central bank then, but let's say you did, and they came and said, well, we're gonna save the horse manure industry. Why not we have them, but automobiles can also work. So the natural evolvement and the natural movement of growth would have been stopped when there's that interference. So I look at it that I see again. We look back and we look at the typewriters. We look at the 1 hour photo developments, and it, we are evolving as a human. We are evolving as industry. We're evolving in, as a global world. So basically, this is what when central bank says we have your back and we will not stop at anything. There should be a question. The question is, I understand we are at survival mode right now. The survival mode is obviously we want to make sure the patient stays alive. The patient needs whatever it needs, we're going to give it, the blood, whatever. But is this patient, are we helping him? Is this going to start walking soon? Is it going to be back to its normal life? And how much of the markets are taken into account of basically as far as the growth of this economy? The way the markets are behaving right now is as if we are going to, or we are back where we were in December, January. They are pricing everything, I think, in my opinion, to the perfection. And that's what concerns me, because they are looking at the companies, and we will talk about Hertz, for instance, one of them, the companies who are, business models, they've made bad decisions, they borrowed a lot of money, that business model doesn't work. They're putting a full value on those companies, and they ignore, again, what is this projections and what is a healthy economy. So in that sense, I have that problem, and it takes me back to Japan. We had the roaring 80s in Japan. I remember I used to work in New York City, and they were buying every single building. This is Rockefeller Center. I remember that. It's like he was saying, well, Sony's taking over and Japan is it, until this what happened. Now, in 1991, 1990, so you can see the stock market, this is, I just start going back to 1985. This is where Japan was in 1985, 11,543. And by 1990, we were more than tripled. We were at 38,916. And that's when the whole recession and the whole thing happened. And what I want to show is this is 1990, and this is where we were at end of December in 2019. We even we probably gotten back 50% of, we're down actually 50% of time that we were in. So one of the things is, do we want to be another Japan? Do we want, in Japanese word, they stabilized it. They are moving, they're still trying to create inflation. They're devaluing their currencies. There's a lot of interfering. They have been buying their ETFs and their bonds. And what is the government or in the central bank's role today? Are they gonna buy equities? What are they gonna do? In Europe, they have been doing it. Is this the real growth story? Is this where the organic growth is gonna happen? And these are the things that concern me. In the meantime, Jim Simmons, which is he's one of the most brilliant men in the last since 1980s. Renaissance Fund has beaten this. People don't talk a lot about him, but this fund is, we talk about Warren Buffett and Ray Dalio. This man has done the Renaissance Fund, who uses a mathematical system, and he's done every year. He's been fantastic. But even this year, this is as of yesterday, his fund was down 20% because of the volatility. So sometimes even the mathematical numbers, they don't make sense. Last week we talked about sentiment, and I like to go through this because fundamentally we can analyze the market, technically we can analyze the market, but I think sentiment plays a big role as well. Again, it's about the collection of psychology of the players. And we've seen this over and over. And the best representative I can say is that the internet bubble in, when 2000, 2001 happened. Some of you are not old enough, but some of you who are old enough remember even going to the parties, and everyone just bragging and telling how many millions. It's not even how many tens of thousands, how many millions they have made investing in an internet company, which was $3 in the morning and would finish like the risk times that they would actually finish like at $50 or $100. It's just unbelievable times. And at that time, you could actually see the euphoria. So the psychology and sentiment do play a role. Now, this is Citigroup's, and which is interesting, and it tells you again where we were right in March, and anytime which is we are about negative 2.2, there is complete panic and fear. And anytime we go over about 30.35, it's getting close to euphoria. And this is where we are now. And this is this week. Last week we read like 63 or so. CNN has its own things. They have the 7 criteria. I just chose one of them to show you. So last week, I believe they were like at 66, and this week they are at 54. And so basically, these are the gauges at least to tell you where the market thinks or the popular belief is. So our goal is obviously when there's extreme fear, that's from a lot of times that's where the real wealth is made. I mean, people like John Templeton's of the world, or Jesse Livermore's traders of the world, they have made their biggest wealth. So I want to go back to check some of those sentiments that we looked at last week. So one of them is the momentum indicator. Last week we were at extreme close to 200. As you can see, that kind of self-corrected itself. Now we are in the 70s, under 70s. So basically we are in a hold position from the momentum indicator. But from the breadth indicator, we still are above that number 80. So there's optimism still there. This was noteworthy. This is from Larry McMillan, who is really an option guru. And if you want to read his book, it's written many books, but Macmillan Options, it's a great book. So he noticed this last Friday, and according to him, the standard equity only put call ratio hadn't been that low in over 16 years. That means people just had put the cautions out the window. And although again, when you hedge, you buy puts, or when you have shorts, you want to buy calls, but it has been a good gauge for the market sentiment. So this was one warning sign. And both breadth oscillators are at all-time high. The most equity calls ever traded in one day took place on Friday on CBOE, and there were no new lows on Friday. So if you look at this came on Monday. Now, and we looked at these last week, if you recall all the sentiments, you could see there were a lot of extremes. Things don't happen at once. They need a catalyst, but when they do, the problem is then the fear comes in, and we haven't even hit the margin calls. We are not there yet. But when that happens, things have a domino effect, and that's how the markets react. And that's what happened this week, although again, there was a lot of enthusiasm, hope. Even when you're down, whether it was 13.3 or 16.3%, we still, it's like the better or worse rather than, are we good? So the other thing also, I think Thursday happened, and in the futures market, and watch it, every second Thursday of every 3 months, there's a roll. And what happens? This is on the equity indexes, which is, let's say, Dow Jones. We have S&P 500, NASDAQ, Russell. What they do, they roll. So if you had a June contract would be expiring, and then, which was that, again, it is on Thursday, the rolling starts. It continues till finally on the 19th. But what happens? We roll from June option and we move to September option. So there is a little balancing act, and it creates volatility. The biggest one, obviously, you could remember was the oil. that the oil contract for May, when it happened in April, that was a consequence of the rolling. Some people had not done it. They had to, there was some exercising and the delivery. And financial don't work like, not like the commodities, but still there is adjustment. So what happens, this is by Friday, some people trade, like myself, I was trading both September and June. June was more liquid at that time, but that also, doesn't help the volatility. Actually, it kind of magnifies it. So I haven't heard this. I don't know if any people have talked about it, but this is based on my experience that also exasperated the move on Thursday. So this is something that I thought it would be interesting to know. Another thing, this is from May 23rd, actually, from Sentiment Trader. And what it says is small trader call option. This is what has happened. The purchases in millions of contracts. Again, we go back for last 6 or 7 weeks, what we have talked about, TD Ameritrade had the best course. Since March, they had opened, since April 1st, they had opened like 600,000 new accounts. Charles Schwab, the same thing, and we call this Robinhood effect. A lot of small traders with the time on their hand, computer in front of them, technology, internet, boy, what am I gonna do? Well, let's start trading. Forget about investing, let's buy. And after that, the debacle we had in March, well, because of, again, that big panic, the time was okay. If America Airline goes down, or UAL, or Disney, or Norwegian Cruise Line, why not? And the fortunate thing is, you have made a lot of money, but when the panic, when fundamentally things change, because of not a solid foundation, it all becomes emotions. So right now we are on a greed. I talk to the institutional investors, and I don't see the conviction in the institutional investors that we are out of the woods and this is the time, except, Pershing's Bill Ackman came, I remember, on March 23rd, right on the day of the panic. And he started buying Starbucks, and he was saying, I'm buying Disney and Starbucks, and this is a great day. And 2 weeks before that, he hated and he was shorting the market. So anyway, but so there are a lot of fund managers that are still on the fence. So what happens when the moves happen, they become more magnified. When there's a panic, it becomes more magnified. Again, once people go back to full, when it's a full economy and people are back to work, maybe things will be a little different. And I think when I started this, our meetings I started with Sean in January, and then we started like in February having our group. My whole objective here for you is to have a system, to have understanding of the markets, so you don't become a reactionary based on what is the news of the day, what is happening, what CNBC is telling you, or what Fox News is, or Fox Business Channel is telling you, what one investment advisor is telling you, what analysts say. I want you to learn enough, have confidence that you can make the decisions on your own, at least have the tools to analyze to see if this is real story. And this has legs to basically provide the opportunities that you were looking for, or this is, again, purely speculation, and this is basically really hope. With that in mind also, I had mentioned it again that in June, you also have a lot of ETFs, especially data ETFs. They start doing realignments. They do adjustments. They look at some of their stronger positions, and they also adjust their weaker positions. With that in mind, I thought, let's look at this. Done it one more in one of them, but let's look at the top 15 holdings of each index. This is the SPDR S&P 500, and just by looking at Microsoft, Apple, and Amazon, these three obviously being also the largest caps, because S&P 500 is a cap, market cap oriented. So they affect the market. So the movement in these affect the S&P 500. And then let's say the tiny little companies, relatively speaking, as far as in the S&P. So by just following some of these stocks, it gives you some indication of where we are heading. If there is a little movement from this, which we did have, you could see like last Friday, for instance, when the markets were so high, well, these stocks didn't do as well. But some low quality stocks, some of, again, economic sensitive, they did well. So that's what like Russell 2000 was moving up, but yet the NASDAQ didn't move as much, or as S&P. Talking about NASDAQ, same thing with the NASDAQ, then you can see with the QQQ. We talked about it, it's almost 50% of the NASDAQ movements is summarizing the top 5 or 6 stocks. The Dow Jones, on the other hand, is not a market cap. The price, and they use a divisor, so more expensive stocks move the markets more. So that's why, like, and for every point, for instance, in a movement, let's say in Boeing, which was, it was at 190 last week or 200, every point that it moved, it helped 7 points. So every 1 point going up, it helps 7 points in Dow. So understanding that, it tells you that a lot of, again, you can see there's a common theme with Apple. So Apple becomes a proxy for Dow Jones, S&P, and NASDAQ. And the last but not least is Russell 2000. Obviously, with the 2000, we don't have the concentration, but there will be some movement. But I thought, just for your information, what companies are in Russell 2000 now. Last thing for last week, again, we had a big move on Thursday, and we'll talk about what happened on Friday, is what sectors for the week, they were the big losers, and they weren't really big winners, but who lost the least. And I want to show you, for the month, for the year to date, where we stand. As you can see, energy was a big winner for the month before that, but then the money moved out, not only because of the oil, but also because, again, the attitude toward the more economic sensitive stocks, that was that little fear that is what is happening with the two things happen, obviously, on Thursday. Main was on Wednesday after FOMC, we digested what Powell was saying. He wasn't as, he has our back, but he's also not sugarcoating a lot of things. And then you had the news about the second coming as far as the effects of the coronavirus. Did we open the states too soon? What is happening with the, this social distancing? Is it working? So basically, you could see the top 3, or actually 4, actually 5, they're all economic sensitive. And that's what they were the big winners the previous week. So these are available on FinViz. As you know, I'm a big advocate of FinViz because they're free, but they give you so much information. So let's talk about, so how can we take advantage of these movements, and how could we prepare? How could we know that the story that the market is telling us is real? And one way of doing that is you have to weigh and balance out between the risk-on assets and risk-off assets. And when I say risk-on, is, let's say you're a holder of your stocks in, so they're like S&P 500, Dow Jones, and NASDAQ. And you're looking at them and you say, wow, they're moving up. This is great. I have S&P SPY on my investments. I think I'm buying a call option on it. I think everything is really good. So to confirm that, you want to make sure that you have a harmony. You have something which is, it confirms your bias. So If Dow Jones Transportation is nicely going up, Aussie dollar, especially it could be Aussie dollar and Aussie yen relationship, but because sometimes a lot of people don't have access to reading Aussie yen, you have access to Aussie dollar in your FinViz, you want to see this story. Crude oil is being more economic sensitive, also plays some role. Russell 2000, we call it the granddaddy of indexes. It tells you is the more risk taker and more, again, is filled with energy and financials, basic materials. What are they thinking? If this is more positive, last but not least, financials are the engine of the economy. And they are the ones, if they don't move, and they play a big role in S&P, then the movement in S&P is really not solid. Although we mentioned about some of the top companies in there, but you really need the financials move with that. So these are called risk on. There's a few more, but these are the main ones. The risk off is obviously we talked about the volatility index. So if the market is going up and the volatility is going up, then the stories contradict. So this is where you have to have a little hesitations on your bias. If Japanese yen is going up and the market's going up, you want to know why that is, because Japanese is kind of a safe haven in a sense that when things are not going well, the markets are not good, people use Japanese yen to park their money. Treasury is obviously the biggest one. It's the bond market. We want the safety of bonds, at least we know, especially US bonds, we know is that security. Hopefully the government still going to be solid after all this printing money. So it is the most conservative, and especially the 10-year notes I look at, and then 30-year notes, bonds. What happens is you want to see, if the treasuries are going up and the market's going up, you want to see what's going on. And the last but not least is gold. Gold is, again, it's kind of a safe haven, although there are times that the markets could go down and gold could go down, because when you are in a panic, you sell everything. And when you sell everything, you're indiscriminate. So, but majority of time, when you have a little more normalized markets, when there's not a big panic, you want to see the money really is like a river. It flows from one asset to another, finds looking for the best avenue, and it is again looks for the biggest reward. So money moves from sectors to sectors, money moves from asset to assets. So if I find better opportunity, let's say in Russell 2000, I'm going to move out of gold. I'm going to move out of treasuries. I'm going to move up Japanese yen. And then because of that, there will be some steadiness in the markets and VIX will go down. So how do we use this? And again, I go to FinViz, and this is at the end of the market, but let's say it's Friday morning. You want to see if there is, again, a harmony. So I look at this. So if it was Friday morning, this is at the end of the day, and you look at this and you say, Dow Jones is up. By the way, the lighter the green, the higher it has been. The darker the green, the lower. They're still up, but less percentage. So I see Russell is the biggest winner. So that means there was some speculation. So the market is, and people are in. Dow Jones, more economic sensitive, industrial. S&P, and then technology. So there was a little cautiousness. The money moved out of this and moved towards these. Crude oil is up, economic sensitive. Okay, so for the green, risk on. I look at Aussie dollar and New Zealand dollar also I use, but it's the little sister of Aussie dollar. Risk on, so we check mark, we say, well, so far so good. It looks like Friday morning, we come to the market, we see these things are in harmony. Then we look at the Dow Jones Transportation when it opens. It's going up relatively, was strong. Then you look at XLF, your financial ETF. That's good. So the market's up. Then I look at my risk off. Japanese yen, it's down. Okay, that confirms the movement. I look at gold, kind of flat. Again, it's not 100%, but in a some big moves. You can see money moves to the gold, but you see silver is down, and precious metals as a whole. Copper, which is more economic sensitive, was up nicely. I also look at lumber, by the way, just if you have a chance. Lumber is again very economic sensitive. Then I look at VIX. I said, oh boy, VIX is down. So my risk off, they're red, my risk on are green. So there is no contradiction. So Friday morning, and I will share with you, Thursday evening, I was with one of my good friends and we were talking, and I said, it doesn't take a big, it's not a big genius to know we will have a bounce on Friday, and from technical and fundamental point of view and sentiment. So we will go over that. This is what happened on this past Friday. So Thursday we dropped. This is S&P 500, right at the 200-day moving average. So we've talked about that 200-day moving average quite a bit because it provides a big resistance, although we really went through it very easily last time. And basically, if you recall, we went through it after 6 weeks of being in this channel with the energy coiling, ready to go. We had talked about this is going to go one way, either up or down, but if it goes, it's going to be vicious. And what happened, once we broke off over this channel, there was three things. There was this channel, there was 200-day moving average, and also S&P was around 3,000. I mean, at that number, the 200 moving average close to 3,000. The round numbers, especially big round numbers, usually create a big support or resistance. So anyway, we went through that, and guess what happened? Thursday, when we had the big sell-off, we came right to that top of this channel, the 200-day moving average, and we went, I think it was like low of 29.70 or something. But what that meant is the next day, we have this support. So because of that support, what we could have at least a dead cat bounce. So we did have our bounce, but the question is, do we have legs? Is this just the euphoria? It was just a big panic, and are we going to go back and break above that 3,200 and move up? And that's what I have a little difficulty. I think these are challenging times. I think if you've had this movement for the next 2 or 3 weeks, I think this is going to be important support. We're probably going to be moving around here, digesting that big move, because when there's a technical damage is done, which this was, and the same with here, we haven't had a big bar like this since actually March 22nd. So it was some emotional damage done. Also, I'm looking at this. This is, as we call this island. You can see there was a gap up and the gap down. It's isolation. So that could create a big resistance. So this is all my opinion. My forecast for the next 2 or 3 weeks is this is what's going to happen. It's going to be very difficult to break above that 3,200. Once we go below this, we're still going to have a channel, and we probably go kiss that 2,700. But in July, we're having our the quarterly earnings coming after the second week of July. Basically, what will happen? There's going to be the numbers are not going to be that great. It's summer. All we need is like a second wave of just a couple of states coming back, and we're going to close, which is, again, this is speculation. So I just want to be prepared if that happened, because that would be very damaging. But even if it didn't, you have the unemployment checks the last ones will end July 31st. I don't know what the Congress is going to do. And I think, although the unemployment claims have been going down steady every week in the last 4 weeks, basically that tendency could continue. But does that justify this number where we were like around October, November of last year, actually around December. Are we in the same economy that we were? Although we are in it, again, stock index, the stock market is a discounting mechanism. They look at 6 months, 7 months down the road. What this tells me that they are saying by third quarter, we are in full recovery. But even Fed is looking at it, the damages they were done through whatever reasons that this happened, it will take about 3 to 5 years. And that's the reason Chairman Powell said, we won't have any rate increases probably till 2022. So basically their prediction is we do have challenges. So how the market discounts and thinks of full recovery is beyond me. So the couple of, again, thing I can say, I think, I don't want to blame the retail investors, but I think that's part of it. I think there's some speculation of kind of snuck in the markets. So I would say we want to enjoy these moves, but be cautious, because I will show you some more charts so you can see where we stand. Because what happened is something like, I look at the volatility of VIX, which is more important than the VIX itself. As long as it's over 100, that means that the market internally is not comfortable. We want it over 100. It usually floats around 70, 80, 90. It went down, but then it's been telegraphing that things are not good. We are at 151. Even on Friday, the market is up nicely. The volatility of VIX, which is the futures market, we look at the months ahead, it means they are counting that the VIX is going to be more volatile, and we are going back to mid-May. So there is, look at these big wicks. So that concerns me. I look at the QQQ. On the other hand, we did break above the all-time high. We still steady. So far, we've been holding our 20-day moving average. We bounced on it once, and this is the strongest of all the indexes for many good reasons. Obviously, with companies like, again, Microsoft, and we look at Amazon, and they're really almost COVID related stocks now. It's the technology, and basically they're holding this index for us. The danger will be that if we break down, then the other indexes will follow, basically, because usually what happens when we break down, the markets like to go from one moving average from 20 and go kiss the second one, which is the 50-day moving average. So once we break this down, but again, I think there will be a lot of some rotation. We will hold this, but I will watch, like, let's say Apple closely, because Apple is in old indexes, and its movements, it kind of helps to explain the movement in, let's say, QQQ, S&P, and the bond market. Remember, we were in this big box, and I had said it, I don't know if I said last time, we were talking about the channel strategy. Now, we were in channel strategy, and what happens when the markets drop in a channel, the distance from top to bottom, usually it's where that the next move after breakdown happens. So we went from, in this case, from 162, we were floating between 162 and 172. And then last week, after employment numbers, the numbers were happening, it was getting warning. We actually dropped and we're very close to that 152. So we had our 10 points movement in the, so this is more of a technical, and first the pattern recognition is a technical projection. So now we are bounced back, we are way over, now we are back over 20-day, and back really making another little channel here. So I will watch this, the bond market very closely. The other one I watch is the LQD. This is the culprit for the the big move in the economic sensitive stocks with this Thursday when, again, Chairman Powell announced that they will be buying $2.6 trillion of bonds, low grade bonds. And so LQD, it gives us a leading indicator as far as where do we have to be worried about the future yet, and not yet. You can see they're holding this pattern. They basically being the market. So that's what the problem arises, because now the playmakers are really not trading too much of this because the Fed or the BlackRock is doing the job for them. So right now we are back where we were right beginning of the March. I also look at IWM, which is again was a more speculative index. It has been the stronger of other indexes. As you can see, we've had big moves in this, and then we broke above the 200. We were above it for 4 days, and when we broke down, we really broke down. So we actually gone below the 20-day moving average, and now here's the challenge. We are all on the stochastics. If we go below that 50, then that means we are in the oversold and the sellers are in control. So I will watch the IWM for the direction of the future. And the transportation, almost a similar movement. We couldn't hold on more than 2 days above the 200. We broke down, and then we had that big gap down. We are right around 20-day moving average. So these are our risk-on indicators. And the next one is financials. Financials could not even go through the 200-day moving average. And now we are below the 20-day. So again, we want to watch this XLF. If the markets want to have legs to up move, the financials have to be the leader. Now, this is really interesting. I want you to just follow me. The XLF, which is the ETF of the large money centers and banks, we couldn't go through the 200-day moving average. This is the chart of Bank America. I want to go back and forth. There's no distinction. Remember, there's I think about 25 holding in XLF. So if the big banks cannot show strength, it's very difficult for the other indexes, especially again, like Russell 2000, even S&P, to go up. S&P is helped by the technology side of it and the healthcare. Gold, in its channel since April, beginning of April, we could kiss the lower bottom, the bottom of the channels, we're coming up. So basically it has its own world. There is, again, need for the insurance. It's not a fear from inflation because we're in a deflationary world, but there is the fear that in the future, the way we are printing money, there could be. So this is really is the storage of wealth in a sense, is for the security. So this is the gold. It's more of a, again, hedge play, not moving, but it's almost like a channel, going up channel, down channel. The crude oil has been nicely, since it broke over that 20-period moving average, it's been going up, but then a lot of acting and politics going on, but we are right at the support. We did go ahead and fill that gap. As soon as we filled that gap, the market was relieved, and usually when you fill that gap, we are done with that move. So let's see what happens here. And the dollar, as you remember, last week we were talking, and that's based on that. We think about emerging markets. This is like a waterfall. It dropped rapidly, and then last 2 days was one of the best days we've had in a while. So again, after the FOMC meeting, you see the money moved back to the dollar. This is what interests me. I'm looking at Hertz. Hertz announced it's going bankrupt. it was about 37 cents or so, about close at 50 cents. It went as low as 37 cents. Then the next day makes this big move. And then, I mean, this boggles my mind. So I don't, first of all, the institutions, not many of them can really are interested to come and buy $2 or $3 stock. So all I can say is there was a lot of players from the retail world looking for a speculation. Let's get in. Some poor person got in here around $6, but tons of call options on this. And I again, that's what concerns me about the markets right now, is there's a lot of speculation going on. So how do we prepare for these? If you have really good profits, I don't think the markets are gonna have big drop in June, because June is, I've mentioned before, is last second quarter. Toward the end of June, usually you will have window dressings. A lot of ETFs make realignments. I'm a hedge fund managers. I'm a mutual fund manager. I have gotten really beaten. Didn't buy a lot of things. I was hesitant, and now I want to show that I'm owning something. I want to make movements. So usually it happens about third week of June. So we'll see if that works. But let's say you want to hold on to some of your investments, but also want to hedge yourself. And there are many ways to do that. You could buy put options. You can use maybe start doing covered calls on your holdings just to have some income on a weekly basis, or you can use bear market ETFs. Now, there is one-time bear markets, there's a two-time, and there's three times. So I'm just going to concentrate on ETFs that relate to the markets one-on-one. So one of them is the natural one, is the VXX. The VIX usually, not all the time, it works opposite of what the markets are doing. So when especially there's a panic or fear, and you can, we were around 10 and 12 for the longest time. And it was a boring 2010s to 2019. It was very difficult for the traders, especially in the futures market. And then you have a month, like between March and, in March, which started actually as we were hitting all-time high in the markets, and we go to almost all-time high in VIX. And you can see as the markets were going up, we were going down, but I don't have the Bollinger Band. We were at the lowest band of the Bollinger Band here, and we were holding way over the 200-day moving average. So anything, usually markets under 15, when VIX is under 15, the markets are pretty comfortable. The markets are in a good hand, they will go up. After going over 20, then the nervousness comes in. So we had a beautiful move up, and then obviously we sold up because the markets were up. One of the tools you can use, which is one-on-one, let's say you own the SPDR ETF, but for short term, you are not sure for the next 3 months. You don't want to sell for whatever reason, capital gains, or you still think there could be a good move up. One of the things you could use ProShares Short S&P, which is a one-on-one. So just as an insurance, I mean, we are hitting the 20-day moving average. This something that it's more of a hedge. It's like you hold it for a while. One problem about these short, and I will go over all of them, is they're kind of like almost option. They are depreciating assets in the sense that, like for instance, with the SH, you really, it's not like a one-on-one with the stock. You actually use swaps. With the swaps, you constantly do have that movement. With these investments, the expense ratio is high, the ETF compared, let's say, with the BOL ETF, so the market ETFs like a SPY and QQ. So it's not exactly one-on-one. What it means, it doesn't mean that if the market goes up 10%, these will go down 10%. If it goes down 10%, this will go up 10%. Sometimes they move up more, sometimes move up less. They hold a lot of treasuries, that's for the cash. And then they as I said, they use swaps. Some of them use like VIX, uses futures. So they have to roll it. So when you roll, basically you have, if it's in the, you're gaining, it works, your work is magnified. If it's depreciating and the roll is costing you, basically you lose money. Plus, again, you pay for the management fee and everything. So I would recommend, these are not a long-term buy and hold, especially if you're going to use a double or triple vehicles. At least the SH is more stable, or PSQ for QQQ. DOG is for the Dow 30. RWM is for Russell 2000. These are one-on-one. EFCs for the global, I would say, is the Europe, Far East, and Australia. And then EUM is the shorting emerging markets. When you get to like something like SDS, I don't have it here because I don't want to, those are really more of a short term. They actually can become a speculation. So I play, let's say, options on SDS. If I think something's going to happen next 3 or 4 days, I just buy the option on QID, SDS. I would buy, let's say, on DXD for the Dow Jones. You could buy TZA for the Russell 2000, but they are, again, depreciating assets. So that's why sometimes you see a lot of these ETFs, they have reverse split. What that means is the price depreciates so much that in order to stay afloat and be on the, attract players, they have to do the reverse. So they go from $1 to $10. They call it reverse 10. So I also have the short financials. The best one for the financials is, this is a 3 times. This is a really good vehicle for day trading, actually, because it moves a lot. So this is called FAS. So if you're really negative about financials, look where we were. We were at 80. We moved from 25 to 80 at no time. So, okay, take a little break and go back and see a couple of trades that I did last week and what were my thinking and why I did these trades. The main one was, and maybe you can learn from either I made a mistake or not. So I bought options on VXX, which we talked about. It was a volatility. I didn't buy the weekly. I bought, because the June 19th was already coming, it's the monthly. So I didn't buy June 12th. This is on June 5th. I bought these options the day that we had that huge move, and we already had the big move in the morning. So I just could not believe the numbers. So I said, I'm gonna hedge myself and I'm gonna buy 5 options on VXX, which is expiring next Friday. And it's a VIX at 29. And I paid $1.95 for my options. As you know, the Monday came, and which I really don't like to play Mondays, I like the Tuesdays. So one of the things I've emphasized before, I put my targets, as soon as I get into my options, I already know where I like to get out. So my first contract is 25%, second contract is 50%, and then I like to make 100% and I have a runner. So I had put my option and I got filled. On Tuesday, things were moving, and I think I got out at like something around $3 or so. So some of them hit more than what am I expecting, so it was a minimum of 50%. But I always keep one runner. And I kept that runner, and I knew that FOMC is going to come, and then Thursday happened. And when the Thursday happened, I had 1 contract left. Now, usually I like to leave it for the end of the week if I'm going to get out, because it's my, that is what I call it, runner. Because I already made enough profit, so I'm not going to lose anything. So I let it go. But when that big move happened on Thursday morning, then I didn't want to be too greedy, because I didn't think you're going to drop that much. So basically I got out at $5.25 or so. So it wasn't a bad day. I mean, I got in at 195. I got out at 525. It was a pretty good trade. Now, on a hindsight, I could have gotten that at about 1470. That would have been a really good trade and could have been a good for in a party saying that how you made 600, 700%. But that was my decision, and I'm glad I did. I sold it and I got into some other trades at that time. So I'm happy with that. So I don't. That's one thing again. I mentioned in the beginning. You have to have your discipline. You have to be in control of your emotions. Don't look back. No regret. No fear of missing out. Oh my God, if I don't get in, look at that hurts. I missed that out. I could have gotten it at 50 cents and could have sold it at 50. I mean, at 5. There's a lot of could have beens in our lives, but be happy with your decisions. Things could have been down here. I mean, who knows? After Powell started talking, and the VIX was actually down here at that time, and I'm like flat. I'm very happy with my decision. Obviously, I could have been a lot more happier, but it's done, and you just have to follow your discipline and your guidelines. That's why I want to emphasize. Anytime you put your trade in, that moment, make your notes at that time, because we as human, once the things change, we want to change with them. It's good to be adaptable, but when you are not in the trade, you have the most clear vision of what's happening. The minute you're in the trade, emotions take over, the hope gets in your decision making, and then you start changing your stops, you start changing your targets, and that's when a lot of again traders especially, they fail. So I just thought that was one. And my other one was I did a lot of mini Dow, and it's actually the 100 too, because things were happening so fast. So this whole trade, I think, I was in 3 or 4 minutes. So this was an overnight. It was I like to do some Asian market trades. It's Sundays used to be really good days for me, and then last 3 months have been so volatile. I don't know what's gonna, things are more volatile than ever. But used to be quiet, and I knew how to make money. And yeah, this was overnight. It was about 10:30 at night. I got in for a few minutes, 15 minutes. I think I did 10 contracts, and it was a profitable day. I don't know. I think it was like $700-800. It's not bad for like 15 minutes, but that's what the futures do. You get in, get out, and then go to sleep. So that's a good thing about trading futures. But I'm not encouraging that. That's something in the future you should, if you're not familiar with it, that will be your last trading vehicle, basically. Now, these are my thoughts about June. June, we're going to have some rotations. I think from now on, the good quality companies are going to be the winners for the rest of the year. You can speculate on more economic sensitives. You can buy airlines, and you can buy cruise lines and travel agencies and some related instruments. But with the Fed coming out and saying that they are going to be on a holding pattern with the interest rates, there's a need for income. And if you can find some good dividend paying investments, equities especially, in stocks, that they've been solid, they've been paying steady dividends, they've had increases, their balance sheet looks really good, then this is a good time to invest in those dividend paying investments. So I thought it's appropriate for the website of the week. There's a website called dividendinvestor.com, and you can click on, you will have the slides. Sean is kind enough to send you immediately, within a day or so you have it. The dividendinvestor.com, it tells you exactly when the dividends are going to come, what kind of historical consistency they've had. Have they been paying for 19 years, 20 years, or have they been around only 2 years? So you can make your own decision. And this is the time I think you gotta be selective. I don't think you should be out of the market. Just play the right strategy, just have the right asset allocation, exactly know why you're in the market for. Are you being a trader? Are you being an income oriented? You want to make money on a weekly basis? Are you an investor? If you're an investor, you got to look at do your fundamental analysis, look at the macro economy, and then be very happy with your choices, and then just stay with them and forget about it. So basically but these are the time to be selective. I think these are the time of being a stock picker rather than a passive investor. So let's talk about a little about dividends, because these are important. If you're going to be the dividend investor, there are just 4 things you should know, and there are 4 dates. So the 4 dates, they come, there's a declaration date, there's the ex-dividend date, there's a record date, and there's the payable date. So what declaration date means is the company comes and announces to the world that we are gonna pay this much dividends in upcoming whatever date it is, which is, we call it payable date. But they actually at that time, they declared that we're gonna pay 20 cents or 50 cents quarterly dividends. The ex-dividend date is that the date that 2 things happen. Number 1, the day before, you have to be the owner of that stock if you want to get paid for that. The second thing is the ex-dividend date is when the stock price gets adjusted. And what I mean by that is the stock is at $20.20. The dividends is 20 cents. When that ex-dividend day happens, your stock, without any news, nothing, with no movement, will drop 20 cents, because that's when the company announced that that's going to be the ex-dividend date. So your stock gets adjusted for that 20 cents dividend payment. The record date is the date that they say, if you're a shareholder and if you want to receive the money on payable date, you should have been a shareholder 2 days before that record date. So you cannot buy the shares on the ex-dividend date or the record date and expect to receive that payable date or the payable dividends. So, and obviously the payable date is when you actually receive that dividend. Now, just obviously it explains what I just said. And then, as you can see, the ex-dividend date is when the market drops. So the second part of this is, it's very important, especially now with these economies, and that's what I really watch, and that's what you should follow, like that dividend investor and the news. If you want to have some income, and again, the yields are pretty good on S&P. This is one of the, it is pretty attractive. But some quality companies, they're even paying nice. You could get 3 or 4% compared to 0.6 or 7% on a 10-year note. So what you want to be careful, though, you want to make sure that dividend payout ratio, which is the amount that comes from your earnings. So if I made $1, what could I do with that dollar earnings, the net income I made for the quarter? I could reinvest in my company, buy some new technologies or equipments, or I could reward some of my shareholders and letting them know, listen, I want to share my profits with you, so I'm going to send you, on $1, I'm going to send you 40 cents, because this creates almost like loyalty, and people don't like to, they like those dividends, so they like to stay before they sell, and the volatility decreases. The problem I have is the times like this, you want to make sure your payout ratio is low. And what I mean by that is that the company, first of all, is not using all its income. And if it did, if it used all its income, that means it doesn't see any growth potential in this company. Unless there are REITs and, there's some income that they have to pay, almost 80%. So I like to see 40, 50%, but I want to make sure it comes from the earnings. Now, when you look at dividend payout ratios of 130%, you got to scratch your head and say, and if it continues, especially, one quarter could be anomaly. But let's say the company made $1 and is paying $1.30 in net income because doesn't want to rock the boat. Where is that 30 cents coming from? So those are the companies that I would be wary. So you want to make sure you do more investigation. Just don't go by, oh, this company is paying 10% dividends. How wonderful. Like let's say Occidental. A lot of oil companies now, they are reducing their dividends because they can see the earnings is going down and they're not going to be able to meet their objectives. So let me give you one example. This is on ExxonMobil. So Exxon came out and said that they declared on April 29th that they're going to pay dividends. On May 12th was that ex-paid dividends, and that's when the stock price dropped. On May 13th, which is usually a day after ex-dividends and 2 days after you should have been a shareholder, they say this is our record date. They go check whoever owned their shares on May 11th, they're going to receive a dividend, and that dividend will be on June 10th of 2020. So if you were the dividend owner, the shareholder, you will receive the dividends at that time. One thing about, again, June, as I mentioned, there's a lot of realignment. So one of the alignment will be on Russell 2000. Russell 2000 goes through the index, which will affect its ETF. They announce in May, some companies going to come in, some companies going to be deleted. So that's why June is important. So I want to show you these dates. So as of on June 5th, they start. And the last day, the market closed on the 26th. Everything is in effect. We have newer companies in, older companies out. And why that's important? It's important because when you're part of an index, you're a part of a basket. When you're part of the basket, if I go and buy that basket, by default, I'm buying your company. So when you are in that basket, then without me knowing, I'm actually buying your company. And when you're included, it's usually a positive news. On the other hand, we've done some studies, and I had mentioned it before, let's say with S&P 500. It's interesting that the company which were deleted or they were delisted they were deleted from the index. When you go back to do the 10-year and 15 and 20-year, they actually did better on their own. So we haven't done anything new. This is a few years back when I did that study, and just a food for thought. But anyway, when you're invested in an index, there's more volume coming in to you for your shares. We're almost end of our time, so I thought I shared this with you. This is a copy of, so before all these internet madness that every single person from a 5-year-old to 90-year-old has access to all the information in the world on their iPhone. For me to have access to all the graphs and other things, I used to subscribe to Investor Business Daily. I did for many years. And what it would do, it will come in a book like this, and then you can see. So it will be pages and pages. It will arrive on Saturday, and that will be one for the NASDAQ, and there will be one for New York Stock Exchange. And this is from May 6, 1994. I was like a little kid in a candy store. I couldn't wait to get their analysis and the charts. And it was not cheap either. I mean, they did a lot of work. I mean, there's a lot of printing and analysis on that. And I'm telling you, we've come a long, long way where we started. I mean, 1980s, I used to draw things by hand, and watch things. And so we are very blessed. We are in a wonderful times. The technology has done magnificent. Sometimes I know is our fall. It kind of, we take it to the extreme from our social interactions to our children. But I look back and I say, oh my God, I used to make my phone trade, especially when I was UK, and I'm trading, and first of all, commissions were like $100 a trade, and then phone calls. I would spend $2,000 or $3,000 a month on phone calls with the clients, and and now everything is for free. Even the commissions are free. I mean, it's just magnificent times. So all I ask you is to be, again, it's the self-mastery. It's like, know your reasons, know your whys and whats, and why you are in this investment, why you are trading, what is your objectives. This way you are not a slave to the markets, you're not a slave to the news. The TVs shouldn't be on. You know the fundamental reasons and just follow that. You don't have to have many strategies, just follow the strategies that you know and use your discipline. And I finish it with this. This is a chart of Amazon in 1998. And it was interesting for me what the projections were. So in 95, they lost money. I mean, they've been losing money. 96, 97, the projection was even losing more money. The relative strength actually was good. But they were, EPS was like 47 earning per share ranking. I mean, Investor Business Daily in 1998 did not think very highly of Amazon. They were like, again, the revenues, the earnings. But isn't that interesting? If you look, you turn the clock back and now go forward. There are companies like this. There are some magnificent. And imagine if I would have followed this, there were companies like AOL, Yahoo. I don't know if you've been Earthlink. Well, the dinosaurs are dead. So basically, they were like the biggest relative strength. The money was going there. And here's Amazon. I looked at Apple, and it's just really interesting. But this is what I used to get. I would love to read this to find out where some of the opportunities, and then you go on the phone, and then I had the AOL for. They had the phone line, and that's how you would get connected and get disconnected when you're trading. But anyway, so with that in mind, I think it's right on the button. It's almost 3:30. So I'm open for any comments, any questions. I'll be happy to hopefully be able to answer those. All right.
Okay, so I have unmute everybody, but I know some of you have muted by yourself. So I have no power here to override that. You can unmute yourself if you have questions, and I do have questions if I can ask.
Okay, go ahead. All right, sure.
So I really like your analysis and also your comments on remember why you get into the trade and don't be just controlled by the emotion. But one thing I had a difficulty is once I get into the trade, the situations always change. For example, I don't want to get into the politics, but there were riots in some cities around the country. It's very hard for me to gauge how important that will affect the market. Sometimes, when the new numbers, economic numbers, even they are really looks bad, when they come out, seems like no effect as the market is just, really up. But sometimes a little change that the market are very sensitive to. So how do you decide whether, those things changed, whether that affect your trade or not, or whether you should update your views?
That's a wonderful question, because we, not only that, I mean, we are, especially in the last few months, we've been very event-driven market. So what happens, and that goes to your preparation, Sean. That's what you look at the factors. First of all, price is always right. That's one thing that's very important. It's not, you cannot fight the price. You cannot say, well, they're wrong. That's why I look at the multi-factors, right? So, and if I'm wrong, and that's what your decision is, let's use an example. You got into Spider and you bought, your forecast was that S&P 500 is going to go up by next week, and you already put your trade in, you're ready, and that's why that you want to make sure if you are in for the next week, you want to have that stop loss. That something like that, which is beyond your control, it 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 kind of saves you. So if you lost 10%, you can live with that. If you lost 50%, not so much. So that's what it's, I put my targets again, because I know if there's a volatility, eventually when it goes up, it might hit it once. And I had some trades on stocks that it happened after markets because it's really jittery. We've talked about after markets, how the market really react to the news. So your thing is, that's why I mentioned before you go in, you have to cover your risk for unseen, unforeseen risks. As you know, part of the risks when we look at even the companies, even you're pricing the from the fundamental point of view, you want to make sure they are covered for the operational risks. If the computer breaks down, or when the hurricane hits them, has nothing to do with their business, but these are outside forces. So when you're analyzing a good company, you want to make sure they are prepared for that. Maybe they paid a little extra, but they maybe have a good insurance, or they have a second or tertiary hedge to make sure they don't break down. They also, again, it goes to your money management, and it goes to your basically your discipline as a risk management. So, but it happens a lot, Sean. I mean, there are times that, again, you have no hold. When on May 6, 2010, imagine when the flash crash happened, nobody ever anticipated that. So, sometimes it's part of the tuition you have to pay to the markets. So, but that's why you have to be prepared, not the moment that you get in. The preparation comes before. You're up at 5:30, you review all the things, you know upcoming events. I mentioned about, you can look at Forex Factory, you know for the whole week, you know what events are going to be there. If the central bank in China or the Australia or Europe, all the decisions, what they're going to talk about. So 3 days, 4 days, like with FOMC, we were prepared. We knew I don't want to be in a trade on Wednesday morning, because I didn't know what's going to happen the next day, except that my VIX, because of the volatility, I had like one left or whatever it was. I was happy with that. But it's all about preparation. It's all about, again, being ahead of time to put odds in your favor. Nobody knows anything 100%. I don't know even 70%. All I know is I want the odds to be in my favor, 55, 60, 65% the most, that I can take advantage of that. And if I'm wrong, I accept my loss and I get out. So I don't know if that answered your question, Sean, but that's how I approach it, because this is the nature of markets. Markets, that's how you get paid, because of uncertainty. If there was no uncertainty, there will not be any premium, and the whole market will be at, Dow Jones will be at 10,000 forever. So that's what happens. And outside influences always going to be there. And if the markets react opposite, which happens quite a bit, bad news becomes good news becomes bad news. You see that in the earnings, basically because of, again, either market has priced it in, or because of this other information that we don't have access to, or we don't know yet. So anyway, But all I can say, market is always right. Remember that. So, okay.
Okay, thank you.
You're welcome. All right. Any other?
I mean, I have a quick question.
Oh, yes. Yes, Jean-Claude.
You mentioned about the stocks leaving and joining the Russell 2000.
Yes.
Where do you get that information? I mean, where do you see which stocks are leaving and which stocks are joining?
So actually, you can go to Russell 2000 website, and they started in May announcing which companies are going to be in and out.
Oh, okay.
The problem with S&P, on the other hand, you don't, the S&P 500 comes out, you don't know till they announce it. They don't give you a heads up. A committee behind closed door, they sit down and they say, oh, we just decided, 2 of our stocks haven't been doing well. Let's bring these other stocks. So what happens is you have these indices to have transparency, and yet this is almost like an emerging country, developing country that you don't even know what they're doing. So it happens immediately. On a side note, by the way, Claude, that's one of the, it's interesting, S&P goes up, and one of the reasons is the bias is because of the losers leave and the winners come. So the bias is almost like the hedge funds, right? So with the survival of the fittest. So a lot of hedge funds, they show these numbers because they got rid of their really bad fund managers. They brought really good fund managers, they including his performance. All of a sudden it shows up in your radar as a great fund manager. And yet, because they don't have that bad fund manager with you anymore. The same thing would happen in S&P. But right. Russell, you go to Russell 2000 and they will tell you what companies. I haven't done that in a long time because I haven't had an interest. There's just so many other things happening.
Right.
I have access to that. But good question. Thank you. Of course. Any other question?
Hi, Uncle. I had one.
Yes, Kenneth. Go ahead.
Do you think selling covered calls and puts is a decent way to make some income?
Yes. So, I mean, with the environment that we are in, again, it's a little volatile, but a lot of people make a good living. They don't, they don't make millions, but if you have a good company and you don't want to get rid of, and I use like a company that you've owned for many years and you don't want to be hit, and you've made a lot of money, you don't want to be hit with capital gains. It's a good way of, again, you got to look at the probability. You got to use a really low delta if you want to do that, which is the probability of that option, being at the money. Then just do that. If you think the markets are going down, rather than selling your stock, do a covered call. It's a great way of making money. But you really have to know the strategy, though. I mean, it cannot be random. You have to know which option you have to sell, what time. You don't want to have like a 90-day option on it. Nowadays, like a lot of people use the weekly options. So, and you don't want to have a huge volatilities going up and down because you can get hard. So, look at the predictability, and yes, definitely, but do a lot of homework though. Don't just randomly walk in, but you have to own the stock if you want to do that. So.
Right. Okay. Thank you.
You're welcome. Good. All right. Great. Any comments? Actually, it doesn't have to be a question. And if one thing I want to go ahead, Henry.
Sorry, I just kind of wanted to follow up. Like in the beginning of this call, you said that you think that there's going to be this kind of volatility for maybe the next 10 years. For me, it's kind of hard not to get into the politics of this. I think I kind of foresee a lot of this political unrest in the future. Myself, I don't know how that will affect the markets, but I just wanted to get your thoughts on why do you think that we should expect a lot of volatility for the next 10 years?
Well, again, we go from cycle to cycle, and what happens is now we almost like the secular movement. 2009, 2010, I don't think we solved any problems. The markets were up, and the unemployment was really down, but there was a lot of other factors involved because our debt, when you look at Fed, we really didn't solve anything from 2008, 2007 excess. So we just accumulated the problem. And I've mentioned it before, and I don't want to just, mention the millennials again, but they've gone through some tough times. We sometimes, again, call them irresponsible in some ways because they're not doing this, they're living with their parents. But they've gone through a lot. We had the 3 crises at the one time during their livelihood. And basically now that I go back to the central bank artificially, and this is again coordinated effort from all the banks. It's not just United States, and that's what it makes it even, it more dangerous in some ways. And it works now because everybody is included, from Euro to China to Australia to Canada to UK. We all we need each other, and we need to have the low interest rates. But eventually, somebody has to pay the piper. And we don't know who that is. Is it the next generation? Is it how about the taxes? I mean, the states are going to be in a big trouble. We are aging demographically. We are aging economy, population. The benefits have to be there. Social Security does not have the funding. So it's gonna, there's gonna be a unrest somewhere. So I remember in the Middle East, we have a saying, unrest happens when there's like really full stomach or really empty stomach. When the stomach is half full, nobody wants to change it. Right now, my fear is the stomach's gonna get a little less full, and the hunger is gonna come to all these societies. And that's when the volatility happens, because sometimes, not having anything dying is almost as better than the life I'm living. So I'm willing to do anything for it. When you have children and you don't have the food to feed them, you go out and do anything. So, and the sample that you saw like last 2 weeks, it wasn't, it was a catalyst, but it was more of an economic uprising in a sense that some people who, I think there was definitely instigation too, but I think we're going to see more of this, not less. And I don't see economically, I'm hoping things are going to work out because of the technological advancement, and some people are going to prosper, but the prosperity is kind of getting more concentrated. And I'm not trying to be political, and I'm not this, utopia oriented. I live in the real world, and my wish is for everyone to achieve the most optimum, capability that they have. But when I see disparity in not just the United States, in all over the world, it kind of takes us to some very dangerous places. The only good thing I think, because of this technological development, on the other hand, I think is bringing equality in some ways. And I've studied a lot in I've really been looking at African economy and their history, and it has always bothered me with all such a rich natural resources, why it has been like that. And the only good positive things is now with the technology, when they have access to electricity, they have drinking water, and then they have internet and the phone, life will be, at least they are more aware, they're not secluded. But I think we are in challenging times ahead. We are not going to have, again, maybe I'm wrong, but I don't think you're going to put your money on 401k, and 10 years later when you retire, you say, oh, great, I made 400%, 300. I think it's going to be much more challenging to manage investments. That's my opinion, as a retired portfolio manager, I should say. So, all right. I don't know. Does that help, Andrew?
Yeah.
Okay,
Thank you.
great. Of course. Great. Now,
Ramin, can I ask one more question?
of course, Ahmad, please.
So I just wanted to get a little bit of sense from you, and I think some came out of this today's presentation, which was very helpful. That if you're trying to get a general sense of market for a day, and you know it changes every day, so I don't think you can go more than a day at this point. But when you look at different things in the morning, are you just trying to get some sense of harmony between all the major indexes, then get some idea about the risk on, risk off effort? Items to get a sense that there's a harmony exists, or are there certain other things that you look at in the morning just to get a general sense of where the market is heading today? What's the mood like?
Right. So, I mean, there's obviously a few other things, but your research should be done like over the weekend. I make some notes from the technical. That's why I like to go over these charts, because charts, they give me a story. They give me a visual where we are. The price is the only fair thing out there. At that time, the buyers and sellers decided this is the price. So, and then psychologically, things like the trend lines and the moving averages, even doing Fibonacci, for instance, or look at the Ichimoku we've looked at. When you look at those, the markets do have, they do have history, and they stick to that. So when there's specific points are your reference points. So if you're prepared for that, then all right, I have this holding. The markets look like in harmony. So maybe I will follow whatever I've had, and I will continue. If I was planning on buying, looks like today is the right day. Now, if you're really looking at the really short term, then you look at the daily, then they bring it back like maybe 60 minutes or 30 minutes to see if there's real confirmation. Is this the best time to get in to buy this? And then, of course, you have to monitor it. And that's why you put your, again, stop loss, whatever decision you made from money management point of view. If you feel 10%, if you use ATR, for instance, if you use moving averages below moving averages, or whatever support or resistance you've used, as long as you have that, this should be on autopilot. I mean, I look at the charts because I'm looking for opportunities, but my holdings are usually on autopilot. I already know if I made mistake, I'm gonna get out at this point. If I'm right, these are my targets, and I'm gonna get out. So I pre-planned. So some of you who've seen me in action, I mean, I don't get nervous. I don't get, it takes time to get there. It's almost, again, like sports. If you play cricket, or if you play baseball, or if you play soccer, once you play the game so many times, when you're on the field, you're really enjoying that experience. You're there to, even when there's like physical challenges come at you, the people are tackling you, you kind of just brush it off and you say, he was really aggressive. I mean, you make sure he knows, but basically you play your game and enjoy it. So that's what you want to be. You want to look at this as a journey. The money comes with this journey, but you want to, and that's why it's important to learn the right tools and try to be in control of your own destiny, not that the markets, whatever they trap you. That's that money management and self-discipline is the biggest one. Now, going back to in the morning when I look at things, I just want to see if there's any question marks. As I said, if there's a contradiction, then I'm prepared. And I think I watch my holdings more carefully, or if I was gonna buy something, or I was planning of selling something at that moment, I will evaluate and say, I wanna see what else is happening before I jump in, for instance. Is that helpful, Hamad? Is that?
Right. So wherever you see a contradiction, then you want to get a little bit to the bottom of it, that what is causing this contradiction, so
Correct.
you have a proper story behind it.
Correct. So usually when the risk off is like in the green, I'm just using, risk off usually is like bonds. Bonds lead the stocks. So if I have a bond trader sitting next to me and a stock trader, I would listen to the bond trader, because bond traders are more, first of all, they're vicious, but they evaluate the things. They are more risk averse. They know what's going on. So I would listen to that. So I look at the bond market first. I look at the risk off, let's say it's the yen, before I look at the risk on. If they're both in harmony, then it's going to be a good day. If there is this contradiction, especially again with risk off, then I would be very cautious. So I would take advantage of, if the markets are going up, I'm cautious and I will take some profits, especially if I'm doing day trading and other things. Just knowing that something could happen. And this happened again, like Monday. If you go back Monday, Tuesday, you could see the story was not, it just didn't match. The markets were going up and the VIX was going up. And you question yourself, well, there's something is not right. So basically, although, maybe they were expecting the FOMC, but I would be cautious at that moment. So yeah.
I see. Thank you.
Yeah,
Thank you,
you're
Ramin.
welcome, of course. Before I know we got a few minutes, but I just want to take this opportunity again, not only thank everyone who's here, and I know you have a lot of things to do. I know some people from UK come and join us, and it's like midnight their time. But as you know, I announced, like Sean announced last week, because of my time strained, I've been traveling, I will be traveling, I will be teaching some courses. And so we decided, we talked the last 2 weeks or so that I think it would be a good idea if we make this more of a subscription base, because as of now, it's only by invitation. Invitation is only for small group. It hasn't been announced anywhere. So I thought maybe July 1st or beginning of the first week of July, maybe we can go to that part of the segment of being a subscription service. But for the next 2 weeks, we can still be available for free. We can, please, if you want to invite someone to come and join us, they're more than welcome. And basically, we can do it in different ways, which we can email you to tell you what are the best ways. Obviously, you have been part of the group, so you get a discounted package. But I think it's all mentioned, that it's fair, after 12 weeks or 10 weeks, it would be a good move to go to the next stage. So we'll be in touch. Sean is going to be in touch. We'll continue this. The slides are always available. Sometimes maybe it's a good idea to go back and look at the past videos, because sometimes there are questions that they might make a little more sense. Let's say 6 weeks ago, they didn't. Now, it's almost, I mentioned, it's like a soap opera, like the stories are coming together. It's more clarity, I hope. And this gives you a little more confidence to pursue, investing and maybe trading in the markets with more confidence. And if anything else, I hope at least your time is spent, you feel is rewarding rather than, wasting your time. So, but we will be in touch. But as always, I really appreciate your time being with us. And we got a few more minutes. If there's any other questions, I'm still available. I'm ready. If not, we can say until next week. Hopefully it's going to be another interesting week next week, and hopefully we are all profitable. And if not, at least stay healthy and well. So, all right. Hey, Sean, do you have anything, please?
Yeah, thank you, Ramin. I think as in previous sessions, I think as Henry and some other members mentioned, it would be good to, have some their trading records, and we have Q&A sessions.
Yeah.
And Ramin and I were talking about this and discussing this. We might have sessions that dedicated to review your trades, and also to generalize from the trades, and have some certain rules that we can share with the whole group. We are planning on that. So just to let you know, if you have ideas or better comments, you can send me or send Ramin emails, so we can incorporate those ideas. But basically, we want to collect questions beforehand, or collect what's your trees records beforehand, and then we'll pick up representative trees, and then we'll have dedicated sessions to review on them. That's a ballpark idea. Thank you very much.
Thank you, Sean. All right. Okay. Well, wish you a wonderful week ahead. Enjoy the weekend. The beaches are opening here, so hopefully you can go out and enjoy the beautiful weather. All right. Have a prosperous and healthy week ahead.
Thank you.
Bye.
Thank you.
you.
Ramin.
Thank you, Ramin.
You're
Bye.
welcome. Bye-bye. Bye.
Bye. Have a nice week.
Next week. Yes.